Greetings, friends. This is Oleh Ivchenko, head of the company Pareto. December is a time for winter holidays, reflecting on the past year and making plans for the new year. 2026 is already at the doorstep, but the business world doesn't take a pause. So, as always, we keep our finger on the pulse in the field of transfer pricing and CFCs. In today's episode, the first results of reporting on controlled foreign companies in Ukraine, the OECD's fight against aggressive tax schemes, and the Multilateral Convention for implementing BEPS project measures. We'll be talking about all of this next. Let's get started. The State Tax Service of Ukraine has published consolidated results of the submission of reports on controlled foreign companies as of December 1st of this year. There are already nearly 30,000 such companies in Ukraine and almost 20,000 controlling persons. The overwhelming majority of them are individuals. 24,000 notifications about CFCs have been submitted, 19,000 notifications from authorized bodies, and 62,000 reports. Most often, CFCs are registered in Poland, 25% of the total number, as well as in Cyprus, the United States, Estonia, and the United Kingdom. The topic of CFCs has already become a routine matter for both the tax authorities and taxpayers. The Organization for Economic Cooperation and Development has published a report for 2024 as part of a project aimed at combating aggressive tax schemes and non-transparent tax benefits between countries. This concerns the mandatory exchange of information between tax authorities of different countries regarding so-called tax rulings and individual agreements with businesses. The focus is on transfer pricing rulings, royalties, permanent establishments, and preferential regimes. More than 140 countries have already joined the mechanism. According to the report, as of the end of 24th year, countries had issued more than 28,500 tax rulings subject to international exchange and carried out over 64,000 exchanges of information between tax authorities. At the end of 2016, more than 100 countries agreed on the text of a multilateral convention for the implementation of tax agreements aimed at countering base erosion, that is, the reduction of taxable profit and its transfer to low-tax jurisdictions. In fact, this was a new joint instrument that allowed for the simultaneous amendment of existing tax agreements between states. The main idea is simple. Instead of rewriting each agreement separately, countries introduced unified rules against abuses, such as when companies artificially avoid permanent establishment status, exploit loopholes in treaties, or create structures solely for tax savings. Those were the news this week. We continue to monitor developments in the field of transfer pricing and CFCs and to share interesting information with you. I, Oleh Ivchenko, and the Pareto team thank you for being with us. We wish you to finish the year 2025 with dignity and to welcome 26 with your affairs in order and your goals clear. See you in the next episode of Pareto Point in the new year. See you soon.